Why don't we get straight into some of these picks that people haven't typically heard about? The first one, Optimize.
OPRX is basically a digital advertising company through electronic health records where drug companies can deliver advertisements and messages directly to doctors when they're prescribing medicines. And as you know, during COVID, a lot of the drug companies had to take their sales forces out of the field, no industry conferences, events to spend money on. They really spent more in digital advertising and saw firsthand the returns they were getting here. And we think this is an example of a COVID beneficiary that will continue to accelerate off that higher base of revenue than other names. We owned Teladoc last year. There's some others that saw a huge rise, but then understandably, having a more difficult time building on those gains.
But up already 95% this year. Is it richly valued?
Well, ironically, the company's not growing too much slower than that. So the fundamentals have really moved alongside the share price until recently. In the last month and a half, the stock's come down considerably. You're seeing pipeline growth over 50% here. You're going to see end of the year budget flush from a lot of the pharma companies. We're expecting a very, very strong fourth quarter. So we're looking at this as being a pretty good opportunity.
What about Zillow, which has obviously had a tough time of late?
So Zillow's a name that we've owned for years, really backed off over the summer as some of the troubles started to emerge with their iBuying business. We were surprised, I think, as well as many others, that they decided to exit this business completely. And then once that happened, we re-engaged in the stock and made it one of our larger positions. Because basically, Zillow today still has no peer. They dominate the online real estate market. They're the leading platform by far. 2/3 of all real estate transactions at some point touch Zillow. And there is one benefit to this. They may actually have a bit better relations with agents and brokerages now that they're not more directly competing with them. So we could see them coming out of this kind of transitionary period even a bit stronger next year.
Let's go to Digital Turbine.
Sure. So Digital Turbine is an app install company. They've basically started with relationships with Verizon and AT&T. Subsequent to that, T-Mobile, American Mobile, Telefonica, and then a big agreement with Samsung a few years back that's starting to really come to fruition. On top of that, they've also made 3 acquisitions in the last year that have really beefed up their revenue, also given them more of the economics, the complete economics. So to give a publisher a one-stop shop to basically advertise on non-Apple mobile devices, Digital Turbine has really established themselves as by far the largest player. So again, it's a name that's been weak over the last month and a half with a lot of growth names, and looks pretty attractive here. The fundamentals have really just continued to improve all year.
Broadening out, Ryan, I wanted to ask you what you felt about the mega cap names, and a simple way of putting it. If you think of the big 4 or 5 companies, whether this time next year their earnings multiple will be higher or lower?
I think it's a great question. We feel strongly that those multiples will probably be lower. When you're looking at the top layer of the market today in tech, so the Apples, the Microsofts, they're trading probably around 20 times forward EBITDA. Now, in the interest rate environment we're in now, you can justify that. That's not really, what you would consider terribly expensive given the current interest rate levels. However, as interest rates rise, there is risks of those multiples contracting. And so even though earnings will go up next year, if it's counterbalanced by multiple contraction, it really makes them less attractive. For our portfolios right now, we actually have the smallest allocation to a large cap tech than I can remember. It's probably less than 5% in our funds.